what are ways that we want to communicate? So when I mean communicate, you're talking with the financial professional, and it might look something like this. So I took a real example and I looked at the S&P 500 and I took the SPY over the last 5 years. So we've ranged from $350 a share up to $700 a share. We've had our ups and downs. 390, 476, 465, 612, 510, 685, and there could be a strategy that as we're going up and down, we're holding different proportions of bonds and stocks based upon where the intrinsic value is and what stock we want to hold. So the communication maybe looks like something like this, where it could be you just kind of letting the investment professional do their thing, but you want an annual communication. And it would maybe look like in 2024, you say, all right, we're entering the year and the S&P 500 is at 475. We find that a fair value. That's why we are right now at 95% stock. Fair value would warrant a higher stock holding for your long-term investments. Now it's January 2025. The S&P 500 or the SPY is at 585. We are at 12% overvalued. We've had a big increase in both companies' profits, but also the price of the stock has grown by quite a bit. So we want to, since we're now 12% overvalued, we want to move from a 95 down to a 25 or a 75% stock holding. Now it's January 2026. The SPY now is at 690. We've had another really big gain on the SPY, and we went from 60.90. The stock market is overvalued by 20%. From there, we are maybe looking at let's hold 60% stock. So as the different time periods and the different valuations come, then there could be a difference between what you're holding for bonds and what you're holding for stock. And you want to create that communication where this is why we're holding it. Now I'm trying to keep things as simple as possible, where if we're just simply only looking at this is the valuation and the more overvalued, the more bonds you want to hold, it might look something like that. Now, if you want to hear, or then if you're going to add in other things, it can be, like I said before, I put a lot of weight and time and effort into options markets. So we're going to hold options contracts so that the dollars that we get in our risk-free investments, so if you're holding 40% bonds, maybe most of those are risk-free investments, you can hold what would be called cash secure puts that will generate additional revenue, or premium, I should say, into your portfolio, giving you some extra rate of return. And then the strategy is that you're buying back the stock at the price you wanted to buy it back anymore. I have all kinds of videos on cash secure puts, but you would just get, okay, how are we yielding extra return in our cash secure puts? And then our objective is we're gonna get about 4 to 6% additional premium dollars for rate of return. And then here's what's happened over the course of the year. We bought, hold, sold stock. So some stocks maybe doubled, some stocks stayed even. Here's what's the difference between the companies. It's just, that's the thing that you want to communicate. So you have a good understanding, is it, why did we go from this percentage bonds to this percentage bonds? Well, it was because we went from right here to right here, right here to right here, and those things will change. So hopefully that's helpful. Communication, also very important.